Welcome to Money Management Part 2, presented by DailyFX Education. The goal of this video is to clearly and convincingly illustrate to you why money management is important. We believe that money management is arguably the most important component to any trading or investing approach. However, we have found it's not easy to convince other traders, especially newer traders, that this is the case. In this video, we're going to try to more clearly illustrate the benefits of money management by reviewing the back-tested performances of an actual trading strategy. By providing you with a more practical illustration of money management, we hope that you'll more clearly see its value and begin applying sound money management techniques to your trading approach. But before getting started, let's quickly review the two money management guidelines that we introduced in the first video, as the merit of these guidelines is what we'll be testing throughout this video. When setting stops and limits, we recommended that your limit distance should usually be at least twice as much as your stop distance. Another way of saying this is that your risk to reward ratio should be 1 to 2 or greater. So if you have a 100 pip stop, we recommend setting your limit at least 200 pips away from your entry price. We also provided a guideline that can assist you with determining what trade size to use based on the size of your account. We suggested that you should never risk more than 5% of your account equity at any one time. So if 5% of your account equity was equal to $1,000, and you plan to open a trade with a 100 pip stop loss, we recommend that your trade size should not be greater than 100K. Let's briefly walk through the math. A 100K trade has a $10 pip cost, and $10 per pip multiplied by a 100 pip stop loss equals $1,000. The maximum that we want to risk at that time. We believe that these guidelines are the foundation for a sound money management approach. As I mentioned previously, our goal in this video is to prove to you that these guidelines are important, that these guidelines are not just rooted in trading theory, but can actually provide real practical value in your trading. Throughout the remainder of this video, we'll be reviewing the back-tested performance results of a simple MACD strategy that was tested several times with different money management settings. We'll be reviewing a total of 3 backtests. One backtest will be considered our benchmark test, which meets both guidelines outlined in the first video, while 2 other backtests will meet one of the guidelines while not meeting the other. We'll consider these 2 tests to be suboptimal. The benchmark test uses a 1 to 2 risk-to-reward ratio when setting stops and limits, and never risks more than 5% of account equity at any one time. The first suboptimal approach we'll review uses a 2 to 1 risk-to-reward ratio while limiting the equity at risk to 5% on each trade. The second suboptimal approach uses a 1 to 2 risk-to-reward ratio while limiting the equity at risk to 10% on each trade. Now it's important to point out that we're not concerned with the actual profit or loss of the strategy. In fact, we believe that this type of test can be performed with just about any strategy, and you should be able to see similar correlations and outcomes that are presented in this video. If you're a bit skeptical, grab a demo account and give it a shot with one of your own strategies, and let us know what you find out. As I just mentioned, we're not concerned with the actual profit and loss of the strategy. What we want to focus on is the relationship between the performance of the benchmark test and the suboptimal tests. By doing this, we'll be able to more clearly see the effects of good or bad money management. Now, we're almost ready to begin pulling up some charts, but first let me briefly explain the strategy that was used for this video. An 8-hour chart was used to locate the direction of the trend, and trades were only placed in the direction of the 8-hour trend. Then a 2-hour chart was used to locate MACD crossovers, which were used to signal entries. A 100 pip stop loss was used on every trade, no matter what, and the testing period was from July of 2007 through July of 2009. This provided between 100 and 200 trades, depending on how the money management was set. Okay, let's bring up our first chart. This chart here shows the back-tested performance results for our benchmark money management approach. So a 1 to 2 risk-to-reward ratio was used and 5% of account equity was risked on each trade. To be more specific, each trade used a 100 pip stop loss and a 200 pip limit. This new chart shows the backtested performance of one of our suboptimal money management tests. In this backtest, a 100 pip stop was used, but only a 50 pip limit was used. That means the risk to reward ratio was 2 to 1, and that we were risking twice as much on each trade as we hoped to gain. To make sure that we can really focus on the importance of our money management guideline, we limited the maximum risk to 5% on each trade on this backtest as well. So only the risk to reward ratios were different between the two tests. Now there are two things that I'm immediately interested in when comparing these performances. When considering the first year of trading from July of 2007 to July of 2008, the benchmark money management test moved nearly lockstep with the suboptimal test, only performing slightly better most of the time. This of course is to be expected as both strategies utilized a 100 pip stop loss. However, the benchmark strategy did use a 200 pip limit versus a 50 pip limit, so it was able to recoup its losses a bit better and thus performed a bit better overall throughout the first year of testing. So the performance during year 1 was better with a 1 to 2 risk to reward ratio, even though it was only marginally so. For many of you this might not be too visually compelling, at least if we compare just the first year of trading. However, when we consider year 2, when the strategy actually started performing better, the argument becomes even more compelling. When times were good for the MACD strategy, the benchmark settings easily outperformed the less optimal settings for two reasons. First, with a 1 to 2 risk to reward ratio, the strategy is gaining twice as much on the winning trades as it's losing on the losing trades. Even being right 44% of the time means the winners are easily outpacing the losers. And second, the benchmark strategy started the second year of trading at a higher equity point. Even though it wasn't drastically higher, it was higher nonetheless. Therefore, when the strategy began performing well, the benchmark strategy had a head start, if you will, on the suboptimal strategy. Take a moment to focus on the distance and separation between the two charts. The nominal returns or losses are not of concern, as a trader's strategy and market conditions can vary so drastically from what we're seeing here. But the types of relationships that you can see here between the two backtests, the fact that the benchmark strategy can recover from losses better than the less optimal strategy, and the fact that the benchmark strategy can really outpace the suboptimal strategy when times are good, are all patterns and relationships that should hold up no matter what strategy you're using or what the market conditions are at the time. This advantage can be spelled out in a different way too. During the first 12 months, the average pip return per trade on the suboptimal test was negative 16 pips. For the benchmark test, the average was negative 14 pips. Now it's not much of an advantage, but it is an advantage nonetheless. And it's important to remember that this was during a time of drawdown. Another important thing to consider when comparing the results of year 1 was the number of trades each strategy placed. The average pip per trade difference may seem negligible, but the suboptimal strategy placed 29 more trades than the benchmark strategy. That's because the benchmark strategy looked for larger gains when trades were going in its favor, so the winners took longer to materialize, keeping the strategy from opening as many trades when market conditions weren't as favorable for the strategy. So again, the average loss per trade is roughly equivalent in both tests. However, because the suboptimal test placed 29 more trades, it suffered greater overall losses. Now let's briefly compare this type of data for the second year of testing. The average pip return per trade for the suboptimal test improved dramatically, going from negative 16 pips per trade to almost 12 pips per trade. The benchmark test made a complete turnaround as well, averaging over 33 pips per trade, up from negative 14. The advantage achieved by the benchmark test when market conditions were in the favor of the MACD strategy was staggering, outperforming the suboptimal test by a full 21 pips per trade on average. When considering how many trades were placed during the second year of trading, the suboptimal test placed 18 more trades than the benchmark test, which is to be expected as the profit target was quite a bit lower than the benchmark test. But the takeaway point from this is that even with fewer overall trades throughout the entire 2 years, the benchmark test consistently outperformed the suboptimal test. Now, to conclude this section, I'd like to briefly discuss win percentages. When considering the full 2 years of backtesting, the suboptimal test had a win percentage of 65%. That means 65% of the trades it placed were profitable, while the benchmark test had a win percentage of only 38%. But take a look at the graphs. Who came out at the end of the year not only profitable, but with some sizable gains? The benchmark test. and it's largely because of the ratio that we set between the stops and the limits. By looking to gain at least twice as much as you're willing to risk on your trades, and also being able to achieve a win percentage of about 40% or better, you really set yourself up for a more stress-free trading environment. Meeting these two conditions can help you from having to be right all the time, and you can keep yourself out of placing more trades when your strategy isn't performing as well. What we just discussed should help illustrate the benefit of money management guideline number 1. Now let's take a look at money management guideline number 2. We'll begin again with our benchmark test. So here we have a 1-to-2 risk to reward ratio and a 5% maximum risk per trade. In this chart, which is our second suboptimal test, we have a 1-to-2 risk to reward ratio with a 10% maximum risk per trade. So in this test, we're keeping our stops and limits consistent. Both tests use a 100 pip stop and a 200 pip limit. However, the suboptimal test put more of the account equity at risk at any one time, which was 10% per trade versus 5%. So the same stops and limits, but bigger trade sizes, which means more leverage. And remember, leverage magnifies gains as well as losses. There's no doubt that leverage is typically an attractive feature for new traders. It's often seen as a way to make quick money. But we can't stress it enough. Leverage can be dangerous and should be used very cautiously. And don't forget, leverage is only beneficial when you pick the right side of the trade. But we all know that's not always so easy, especially for new traders. If it were, we wouldn't need trading courses like this one. Now, it won't be necessary to go into as much detail here, as the charts are very straightforward. It's probably very apparent to you that both tests seem to track each other's movements fairly closely, with only the amplitude or velocity of the movements being magnified with the suboptimal test. Just think about it, with the same stops and limits, both tests were likely in the majority of the same trades for the same lengths of time, the only difference being the trade size. And that's why you see two charts that seem to move in tandem, with the suboptimal only making larger dips or spikes. Now, I will admit, the large drawdown that the suboptimal trade experienced during the first year of testing might not have happened with an alternative trading strategy, or if market conditions were different at the time. But for the purposes of this video, I'm glad it did, as this type of drawdown can really affect trading psychology. After about 7 months of trading, the suboptimal test was down from its starting equity of $10,000 to around $3,000. That's a loss of about 70% of capital, and account equity stayed around the $3,000 mark for about 5 months. Now, ask yourself honestly, could you stomach that kind of a drawdown? Even if you could, is it worth taking on that potential risk to only potentially reap larger gains from the use of leverage? Now, you could certainly argue that even the benchmark strategy took on a large loss, in this case about 40% at its worst point. But that's really not the point. Remember, the nominal performance of the tests is not really what we're concerned with. We're concerned with the relationship between the two tests. And you can clearly see that when the market was not suited for this strategy, the suboptimal test took on substantially greater losses than the benchmark test. And even more importantly, consider this. It's safe to say that most people are willing to risk more of their account equity at any one time because they have the hope and expectation that they will end up magnifying their returns. But again, these charts provide so much insight into the benefits of sound money management. Look at the equity level of both tests at the conclusion of 2 years of testing. In fact, look at the equity level of both tests throughout the entire 2 years of testing. There was rarely a time that the riskier test, which used more leverage, ever outperformed the less risky test, which used the benchmark money management. Now, this specific outcome does not relate to all market conditions or trading examples. If we had only run the test from July of 2008 to July of 2009, it's likely that the suboptimal test would have greatly outperformed the benchmark test. But that's only because market conditions were favorable at that time for the MACD strategy. And you and I both know the future is uncertain. We have no way of knowing for sure if market conditions will be favorable for our strategy or not. So by limiting the amount of risk that we expose ourselves to, we can maintain more account equity and have more staying power in the market. I'll conclude by saying that there are certainly times where cautiously using more leverage might make sense, but it should be very clear from this example what the dangers are and why we recommend to traders to never risk more than 5% of their account equity at any one time. We hope you found this video helpful and hope that it provided you with a more practical analysis of money management and showed you why it's important. We encourage you to join us for a live webinar on money management with one of our course instructors. In the live webinars, we'll discuss real-time trade setups and show you how to properly set the money management for those trades. We will also have a live question and answer session where you can ask the instructor specific money management questions. Thanks for watching this video, and good luck with your trading.